Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we're going to be talking about dividends. What are they? Are they important? And if not, what is important? Anthony, I'm going to jump in here and start this off because I can distinctly remember sitting in a meeting with another advisor, and he was sitting there communicating the dividend rate as if it was the growth rate inside of the policy. Exactly what he said was, hey, this company paid a dividend last year of almost 5.5%, 6%. Wouldn't you want your cash value growing at that rate? And I sat there and I cringed.
Was this a new agent?
No, he was a seasoned agent. His name was Manthony Faso. No, it was not Anthony, but no, unfortunately, it was a seasoned agent. The guy had been in the business for a very, very long time. Man, and I sat there and I heard that and I just cringed and I was thinking, oh my goodness, he's giving bad information.
When I hear that, it actually makes me angry.
Yeah.
For two reasons. Most importantly, the client doesn't know what the dividend rate is. They're based on what the agent is advising them. So they're giving agents bad advice, and also they're giving other advisors and agents a bad rap. Oftentimes, and sometimes there's a bad rap on life insurance agents, and oftentimes it's well deserved.
Yeah.
Because there's an example of people giving misinformation.
Yeah. Couldn't agree more. And so let me dive in here and let's kind of let you guys know what a dividend is actually made of. A dividend, when we work with a mutual company, is actually a return of the profits at the end of the year. When we work with the mutual companies, they realize those profits, and because with mutual companies, the policy owners are the owners of the company, is they pay out that profit to the policyholders, and that's what's paid out in the form of what's called a dividend. What makes up that dividend is actually three pieces. The first piece is going to be the investment returns. So insurance companies are actually taking in premiums and they're going out and putting dollars to work and they get a return on that. And that typically makes up the largest portion of that policy. The other part of it is the mortality expenses. So underwriters, when they admit somebody to have a policy, so that selected group of people that they allow to put policies on, is they project the number of people they're going to pass that year and the amount of risk that they have. If they have lower than normal people that pass that year, then they've got more that they can distribute out in the form of dividends. The last piece is going to be the administrative costs, and those are, think of your fixed costs for just running the business on a day-to-day basis.
You know what I think is you just mentioned that there's three pieces, but really I think most people think it's only one.
Yeah.
Right? And so as you'd mentioned, when they're designing the product, they're estimating and using actuarial science to determine like what the mortality and what the death rate is going to be. Now, when they do that, are they putting it exactly at that amount, or are they putting in a fudge factor?
No, especially in regards to the mortality piece of it, is when they're projecting out how many people are going to pass, is there definitely have, for lack of a better word, a fudge factor, right? I kind of think of it as when somebody builds a bridge. They don't build that bridge for a finite number of cars to be on it. They overbuild that bridge. And so it's the same thing here, is they always overestimate their expenses on that mortality side.
And, as we've talked about before, I mean, the investment piece is somewhat tied to interest rates, right? So those interest rates are going lower. So dividends, they're having a hard time finding investments, right, to meet those original projections. But I just want everybody to know that the insurance company, I mean, they're working for us.
Yeah.
Right? So they're being proactive, because I know in a couple policy companies we work with, they have done some good cost-cutting analysis where they've maybe redesigned some of their overhead, that they're being more efficient. They've had some layoffs, right? So they're trying to keep that admin cost low, and a lot of them, particularly the good ones, have even lowered the way that agents are paid in commissions. So they are being proactive, and us as agents are totally fine with that. And even with the mortality rate, I mean, I've gotten a lot of questions like, oh, what about COVID?
Yeah.
Right? How's that going to affect these insurance companies? You know what was interesting? This stat was as of June of last year, so right when it really started getting hot. With this one company, the actual death claims for that year were actually at that point, so the first half of the year, were actually less than what they had expected. And I think a large part, if you look at the mortality rate, the mortality rate is fairly low, and particularly where it's highest in the age group, the people that are over 65. And a lot of times, they may not have life insurance. So the COVID has not had a big issue, and the insurance companies are doing what they can to keep that dividend rate as high as possible.
And then just to dive in there on the investment piece of it is typically insurance companies will invest in just a few places. Typically it's bonds, right? They own that 30-year bond market. They invest in commercial real estate, very large projects. They do joint ventures, and they also invest in policy loans as well. So Awesome. All right, Anthony. So here's the question of the day. Now that we know kind of what makes up a dividend, how important are they? Are they important?
Are they important? I would definitely say no.
Okay.
They are not important. And it's just a piece of the puzzle. Right? And also what is very Go ahead.
Let me make sure for the listeners, because if I was listening, I heard that are you saying that dividends are not important, or are you saying that the dividend rate or the emphasis that people put on that dividend rate is not important?
I would say all the above.
Okay.
Right? Because then I know we're going to talk about what is important, but I know a lot of times we're talking about dividend rate, and I will tell you, average person has no idea what the dividend rate is, right? And it sounds to me like some agents don't even know. I'm not pointing at you, Cameron, but just the story that you had shared.
Oh, got you.
Right? But what is interesting, we actually have a report by one of the top mutual companies, right? And it's touting their whole life dividend interest rate. Okay, and it's comparing it to about seven other companies. Okay. There's some pretty interesting nuggets on here. For one, it even says on the bottom, this information should not be used to predict or determine product performance. Right? And isn't that when people are touting the dividend rate?
Absolutely.
What I found, the people that are touting the dividend rate are not really clients or people looking at it. It is other agents. And typically when they get involved is when they hear that they're considering doing a whole life product. And they're like, wait a minute, my company does that.
Yeah.
Right? And I even had with a company that had touted such a high rate, right? And so the client had reached out to his advisor. I don't know what was that conversation, but that agent, man, spent a lot of time, and it created 2 reports. And one of them was analyzing this company on how great it was, and then it was comparing it to the company that I was recommending. And what I thought was interesting, not all the numbers were there, but it just seemed like it was cherry picked. Like every number,
just the good ones,
right? Yeah. Everything that they looked at, this company was better than the one that I was recommending, right? But what was interesting to me, like it's all about the bottom line. Right? Yeah. I mean, in the policy, on the illustration, which is what people are evaluating, I mean, there's cash value, there's dividends, and there's a death benefit.
Yeah.
And really for what we're trying to do, Cameron, what do you think is the most important piece of those?
Cash value.
It's cash value. And by far and away, right?
Absolutely.
Okay. So if that is that should be the barometer if you are deciding between these other companies. But the way that this company designed a policy almost very similar as far as base and PUA, right? The same way that I did it, and partly I think they took my policy and tried to recreate it. But this company was touting their higher dividends, but our design had more cash value every single year.
Yep.
And I'm not sure where we were with the dividend. I'm sorry, with the death benefit, but we had more cash value, and that's what he was looking at, because there's a lot more things that go into the cash value than just the death benefit. And that's why this report is saying that this does not predict performance. And it says it should only be used to establish historical trends. And then on the top here, it says these dividend rates should not be the sole basis for comparing insurers or policy performance. Right?
Yeah, I'm going to jump in there. You and I did an interview with some executives from a very large mutual insurance company that we do use in the past, and we brought this up, and he gave an excellent answer, and I kind of quoted it, but he made a couple points. The first point that he made was that mutual insurance company that we were interviewing, they actually don't declare a dividend rate.
Why not?
Yeah. What he said was they don't declare a dividend rate because they believe that rate is not useful and is in fact more likely to be misused, as it is just one of several variables that go into determining a dividend rate. And each company does it slightly different. What he did is he went on to say that those three pieces that we highlighted earlier, administrative costs, mortality, investment returns, is an insurance company can omit one of those if it chooses, and so it can kind of pick and choose what their dividend rate that they want to publish. And so I thought that was very interesting. I did not know that at the time, and so right there, having one mutual insurance company that just steps back from the table and says, listen, I'm not even going to declare it because it's more confusing than anything else, I thought was very telling.
Great.
Yep. Awesome. What else we got? Okay, Anthony. So what we did is we just went through and we talked about dividend rate. It's often emphasized, and a lot of times it's typically somebody that is with a very large mutual company that may not have great returns, so they try to emphasize dividend rates. So what is important?
Well, I think what we're kind of looking at is not really on the illustration per se, but which company we're going to use, right? If you're dealing with some of the top mutual companies, you do a standard policy, however we split it. If it's going to be very similar.
Yep.
Right. And we've even talked about when we've had Todd Langford on, who is more of a technician when it comes to all these numbers. And he said there are no deals in life insurance.
Yeah.
I mean, if some company gives you a little bit up front, well, then you're gonna have to pay for it later on in the future. So it's kind of all of a balance. But to me, what's important is really how you're going to use it and how you're going to design it.
Great.
Right? Because we have some great companies that, like, if you're going to do something annually or monthly, this is one of our that we think is the best company for that.
Yep.
Right? But oftentimes we have people that want to kickstart, right? Where they have some money on the side and you can dump some money in the beginning of the first year. You're not obligated to continue to do that, which really increases that cash value quite a bit the first year. So we start compounding, but also more importantly, we can start using it 30 days later. So if that's something you want to do, then that first company we looked at is not the best. So it ought to be another company, right? And sometimes we have clients that have a windfall, right? Maybe they sold an investment, or they did a cash out refi, or they sold a business, or whatever that or is, or maybe there's inheritance. We only have so much money, and they can't commit to paying ongoing premiums. Well, as we've talked, there's companies we use that have that single deposit. So we use that company, right? And some of it, in rare cases, it also goes to what your medical history is, or more importantly, I would say your lifestyle, right? Because I've had clients that do rock climbing, right? So some companies are like, you know what, we're going to put an extra charge on that.
Yeah.
And some companies are like, you know what, they ask more questions and are fine with that. Mm-hmm. So we're going to go with a company that's going to give them the better rating. And particularly what's going on now, like with cannabis being legal, right? People are using cannabis, and all the companies we work with were like, you know, hey, we will approve you, but we're going to give you the same rating as we would a tobacco user, which when we do it for a whole life, that doesn't make that big of a difference.
Yeah.
Right. But it does for term. Right. But there's one company which literally in their underwriting says if you smoke less than 2, I'm not sure what the technical word is for a joint, but I don't know. But I think you kind of know where I'm going.
Yeah.
Right.
Yeah.
If you smoke 2 joints, you're golden. That's fine, right? But if you smoke 3, you're going to be tobacco. So then we're going to go with a company that's going to give them that rating, and that is going to provide them more long-term results than chasing some sort of dividend rate.
Yeah. What I'll add to there is also what I would put emphasis more on would actually be some of the riders that are available with different companies and how we're going to exercise those. What came to mind was the flexible PUA riders, right? Is some companies will allow us to just pay maybe $5 a month, $30 a year to keep that PUA rider on there, and you can come back anytime and max that out, whereas some companies don't, right? And so if you don't exercise it, you lose it. And the other one that I thought of was our overloan protection rider, which I know you're a big fan of as well, that some companies just don't have that rider.
What is the overloan protection rider?
Overloan protection rider prevents that policy from lapsing and becoming taxable on the back end. So it prevents us from taking out too much money. So it's a great policy or a great feature to have on a policy, and not a lot of companies do have that.
Correct. And to me, what is important, for one, we don't want that policy to lapse.
Yeah.
Right? Because typically it would do that probably when we need it most, right? When we're in our 70s and 80s.
Yeah.
Okay. But also, in addition to not having the death benefit, you're going to get a 1099.
Ooh, yeah.
Right? Because it's tax-free as long as it's inside the policy, but if that policy lapse, now that gain we do have to recognize. So now you're 70 or 80, no death benefit, and a big tax bill, right?
I would say that's more important than a dividend rate. Last thing I'll say here on this point is really what I see most often, Anthony, and you can share your experience, is that typically it's a captive agent that is out there promoting dividend rates.
Now, what does captive mean?
Captive means you can only write with one company, right? I'm not going to name any companies out there, but typically, hey, they've got one company they can write with, and so maybe that company has a really high dividend rate, and that's what they lead with, and that's what they put the most emphasis on, right? Anthony and I don't know how many companies you're contracted with, but I would say easily a handful, right? 6 or 7 for me, and so it's the same thing. Not like
I have 7 or 8, but
yeah, I'm probably 9. But it just depends on the certain situation on which company we're going to go with, and it's certainly not driven by dividend rates. It's just driven by all the stuff that we just touched on.
So then I think it's also important to be working with an agent who is independent, right? Because like the companies that have these captive agents are typically some of the top ones.
Yeah.
They're great companies. Like, I'm not going to badmouth their illustration. We don't badmouth any companies, right? Or any of the top ones. Some of the ones on the bottom.
I only badmouth one person. It's you. In summation, right? You got anything else to add?
No, you kind of left. I did have something, and you kind of threw me off there.
I got you distracted. That's easy to do.
Yeah.
All right, so let's summarize this thing, Anthony.
Oh, no, where I was getting at, that it's important that you're dealing with somebody who has access to other companies, right? So they're not obligated to or forced to put you with one company.
Yeah.
You know, that even though that company is great, but maybe on your situation, it's not great for what we're trying to do. And also, what I tell people, even in that example that I alluded to earlier, where this agent was trying to get the case, you know what? Even if the let's say things were reversed, that the policy I was recommending was much less than the one this other guy was, right? There's a lot more to the numbers, right? We did the podcast, the last podcast, what is seen and unseen, right? What you're seeing are those numbers. But I guarantee you, if working with us, we're going to show you how to use it.
Yeah.
Right? That guy, their company is not going to allow him to say, hey, you know what? Why don't you use a policy loan and go buy a rental property?
Yeah.
Right? Or why don't you do that and start a business? Or why don't you start flipping land?
Yeah.
Right? So I guarantee you, I would say, man, I would bet if this company could double their dividends, right? The company I use paid no dividends.
Oh, okay. I see where you're going, yeah.
I'd be willing to bet in 20 years my client would have more passive income and more net worth, meaning that cash value and the investments that they use. So that's why I say I don't want to discount dividends per se, but it's just a small piece of the puzzle.
Yeah.
There's so many more things working on, and we've talked about, and I tell you, one of my favorite pages in Nelson Nash's book is when he talks about the equipment financing. And I know you're probably driving here, but I'm just going to give you a quick little analysis here. What he's doing is he has one example where you're only funding a policy in this example for a few years, right? And then they have passive income on this at 66 of $92,000. Okay. Then we have the exact same policy. I mean, exact same, but in another scenario, it's making $225,000, right? So more than double the cash flow, but it's the same policy. How much did the insurance company do to make double cash flow?
Yep.
It wasn't the insurance company. It was how you were using it. This individual started using it to finance his equipment. So that's what's going to give you the bigger results, not what's happening inside the policy. Your policy is just really a high yield cash management tool.
Yep.
Right? The real investments are going to be what you do on putting that money to work.
Yep. And I'm going to reiterate what Nelson has said in his books over the years. It's not about rate, it's about volume. Right? So anytime somebody approaches us with rate, is you got to take a step back and look at this and say, hey, usually, right, that's a distraction from what the real objective should be, and that's looking at the amount of money that we're going to have at the end of the day. And then the 80-20 rule, right, is 20% of what – this is what you were alluding to. 20% of what we do is really just the policy design, and that dividend rate is even a smaller percentage of that. 80% of what we do is create wealth outside of that policy, and that's where you talk about passive income and real estate and businesses and everything else there. So
now, I bet there's probably some of you out there that was like, well, I have a whole life policy. I don't know, is it designed correctly?
Yeah.
Can I use it for banking?
Yeah, nobody's told me how to use this, showed me how to use it.
So what would you tell them to do, Cameron?
Call in, right? Give us a call. We've got Discovery call. We'll put that in the notes. Spend 5, 10, 15 minutes with us, and we'll give you some ideas. We'll let you know if you've got a good policy, bad policy, or just give you suggestions on how to use it.
Because what a lot of people, they don't know what they have.
Yeah.
Sometimes there's a good policy. Sometimes there's a bad policy. We give our honest opinion, and if you can use it, then use it.
Yeah,
right?
We were on a webinar yesterday, and maybe there was 4 or 5 questions that came in right in succession, and it was, hey, I've got a flexible, I've got a universal, I've got this, and it was all kind of the same thing, and, really it's just one product that you just use different names for it, and so, we can give some clarity on what you guys have. We'd be happy to help you.
Perfect.
Awesome. Anthony, great job.
Thank you.
Yeah, well done.
I wish I could say the same, but we did have a good podcast. Hope we had some good information. Hopefully kind of realize dividends are just a piece of the puzzle.
Exactly.
Right?
Yep.
Now, go make it a fantastic day.
Take care.